Most investors are searching for the next hot stock, the next big tip, the next thing everyone is talking about. But after 20 years in this industry, as an investor, I can tell you this with full confidence. The ETFs that quietly compound your money for a decade are worth more than any hot stock tip you will ever hear. Today we are ranking 9 of the most powerful ETFs on the market, from lowest to highest based on their real 10-year average annual total return. Not one lucky year, a full decade, through crashes, recoveries, bull runs, and everything in between. Drop a comment below telling me which of these you hold and how long you've been in it. That helps newer investors in this community more than you know. All investing carries risk. Do your own research. Nothing here is financial advice, and I am not a financial advisor. Let's rank them. Number 9, VXUS, the Vanguard Total International Stock ETF. This fund gives you access to over 8,500 companies outside the United States, Europe, Asia, Latin America, emerging markets, all in one position. Top holdings include Taiwan Semiconductor, Samsung, ASML, and Nestle. It holds over $107 billion in assets with an expense ratio of just 0.05%. 10-year average annual return is approximately 8.4%. That number looks modest compared to what comes later, but VXUS is not just about return. It is about balance. When U.S. markets struggle, international markets do not always move in the same direction. That diversification has real value that a single number cannot fully capture. Number 8, VT, the Vanguard Total World Stock ETF. If VXUS covers the world outside America, VT covers everything. Over 9,000 stocks across the U.S., developed international markets, and emerging economies all in a single ticker. Leading positions include Nvidia, Apple, Microsoft, and Amazon. VT holds around $55 billion in assets at a fee of just 0.06%. 10-year average annual return, approximately 11.9%. One important thing to understand, VT is market cap weighted, which means the U.S. still dominates the top of the fund. You are buying the whole world, but American companies still make up the largest portion of it. Number 7, SCHD, the Schwab US Dividend Equity ETF. This is one of my favorites on this entire list, and your dividend investing community knows exactly why. SCHD tracks the Dow Jones US Dividend 100 Index, 100 carefully screened U.S. companies that have demonstrated consistent dividend growth, strong balance sheets, and real financial strength. After its 2026 reconstitution, one of the most significant reshuffles in its history, SCHD rotated out of overheated energy names and added high-quality healthcare and financial companies. Current top holdings include Chevron, ConocoPhillips, Merck, and Coca-Cola, with United Health Group and Abbott Laboratories among the major new additions. The fund holds over $80 billion in assets at just 0.06% per year. Current dividend yield sits near 3.4%. 10-year average annual return, approximately 12.3%. Here is what I need you to understand about that number. Most serious investors consider 8 to 10% per year over a decade to be excellent. SCHD has delivered over 20%, while also paying you growing dividends, maintaining lower volatility than the broader market, and holding companies that have proven they can grow their payouts through recessions and crises. That combination is rare. That is why this ETF belongs in so many long-term portfolios. Number 6, VTI, the Vanguard Total Stock Market ETF. VTI owns a piece of every publicly traded company in the United States, large, mid, and small cap. One fund, the entire U.S. equity market. Dominant holdings are Nvidia, Apple, Microsoft, and Amazon. VTI manages nearly $580 billion in assets with an expense ratio of 0.03%. 10-year average annual return, approximately 13.5%. This is the classic core holding. Broad, cheap, diversified. It does not try to be smart. It just owns America. Number 5, VOO, the Vanguard S&P 500 ETF. VOO tracks the 500 largest, most successful publicly traded U.S. companies. The same leading names appear at the top: Nvidia, Apple, Microsoft, and Amazon, reflecting that the biggest companies in America drive returns across both of these funds. VOO is now the largest ETF in the world, holding nearly $830 billion in assets at just 0.03% per year. 10-year average annual return, approximately 15%. VOO edges past VTI over the decade because the S&P 500 operates as a quality filter. Companies that stop delivering get removed and replaced. The index is continuously refreshed with America's strongest performers, and that discipline shows up in the long-term numbers. Number 4, SPMO, the Invesco S&P 500 Momentum ETF. This is where the list starts to pull away from the pack. SPMO holds the 100 stocks inside the S&P 500 that have shown the strongest upward price momentum over the prior year. The strategy is straightforward: own the winners and ride their strength until the trend changes. SPMO reconstitutes roughly twice per year, automatically rotating into whatever is gaining momentum and cutting whatever is losing it. That built-in discipline means the fund is always aligned with what the market is actually rewarding. It manages around $13 billion in assets at 0.13% per year. 10-year average annual return is approximately 18.1%. This fund has beaten the broader S&P 500 over the decade by staying in what is working and exiting what is not. For investors comfortable with slightly more movement, that edge has been worth it. Number 3, QQQ, the Invesco QQQ Trust tracking the Nasdaq 100. QQQ holds the 100 largest non-financial companies on the Nasdaq exchange. Technology, communication, and consumer innovation make up the core of this fund. Nvidia, Apple, Microsoft, and Amazon lead the holdings, with nearly $285 billion in assets and a fee of 0.20%. It is one of the most widely traded ETFs in the world. 10-year average annual return is approximately 18.6%. For investors who believe that the companies reshaping the global economy will continue to lead the market, QQQ has been the most established and liquid way to own them. Number 2, VGT, the Vanguard Information Technology ETF. VGT takes technology exposure further than QQQ. Rather than spreading across multiple sectors, VGT focuses entirely on the technology industry. Over 300 companies spanning software, hardware, and semiconductors. Nvidia, Apple, Microsoft, and Broadcom lead the fund. VGT manages around $50 billion in assets at an expense ratio of just 0.09%. 10-year average annual return, approximately 22%. That is nearly double what most investors would consider a great decade of results. And VGT delivers it at a cost that amounts to less than $1 per year on every $1,000 invested. And number 1, SMH, the VanEck Semiconductor ETF. Semiconductors are the foundation of everything in the modern economy. Artificial intelligence, electric vehicles, data centers, cloud computing, all of it runs on chips, and the companies that design and build those chips have been the single best performing group in the entire market over the past decade. SMH holds the 25 largest US-listed semiconductor companies. Top holdings include Nvidia, Taiwan Semiconductor, Broadcom, and ASML. It manages around $40 billion in assets at 0.35% per year. 10-year average annual return approximately 32%. A $10,000 investment in SMH made a decade ago grew to over $170,000. That was a gain of more than 1,600%, with dividends reinvested through good markets, bad markets, and everything in between. The trade-off is real. Semiconductors are cyclical. You can see sharp pullbacks, but the global demand for chips is not slowing down. The AI era has only made it stronger. 9 ETFs, a full decade of proof. The question is never just which one had the highest number. The right question is which of these fits your timeline, your income goals, and the life you are actually building. Smart investing, profitable results. This video is for educational purposes only and not financial advice. Past performance does not guarantee future results. Please consult a licensed financial professional before making investment decisions.